Hello, and you're welcome to Global Business Insights, where we consider the main headlines all over the world, going a little deeper from a business perspective. UK retail sales for May just came in at a strong 2.9% month on month, almost double 1.5% expected, and much better than last month's drop of 1.8%. Still in the UK, yesterday the Bank of England kept interest rates steady at its June meeting, describing the decision as finely balanced after UK inflation hit its 2% target. We will replay the clip on our analysis of the decision. Later in the evening episode, we will bring the latest Purchasing Managers Index PMI updates from UK, Europe and US. That's coming out later today. Japan's May Consumer Price Index rose on an annualized basis to 2.8% versus a previous print of 2.5%. Core CPI inflation, or inflation less volatile food prices, rose less than estimates, up 2.5%, higher than April's 2.2% print. The core index, which excludes both food and energy prices, slowed to 2.1% from 2.4% in April, marking the ninth consecutive month of deceleration as domestic consumption remains sluggish. Federal Reserve Bank of Richmond President Tom Barkin late Thursday commented that the Fed has the firepower to address policy issues looking forward, but has to maintain its strict data-dependent approach. And on data, we got US May's building permits and the Philadelphia Fed manufacturing survey for June, both cooler than expected, while initial jobless claims came in also above the 4-week average. The count of US citizens seeking unemployment insurance benefits was up by 238,000 in the week ending June 15. This was higher than estimate of 235,000, but less than the previous weekly gain of 243,000. US housing starts, that's a measure of US home building, declined 5.5% in May to a seasonally adjusted rate of 1.277 million, reflecting lingering weakness due to high mortgage rates. Markets are hoping for earlier than expected rate cuts in the US, given the data. The CME's Fed Watch tool, which looks at probability of the kinds of rate cuts or interest rate movements we're going to see, sees over a 70% chance that the Fed will deliver a quarter point cut in September. As US markets returned after the holidays, stocks retreated from record highs, ending the Nasdaq's longest winning streak this year. The S&P 500 yesterday closed 0.25% lower. The Nasdaq Composite also fell 0.79% after hitting an all-time high earlier, while the Dow was up 0.77%. Nvidia stock fell 3.5%, losing its most valuable company spot back to Microsoft. Still in the US, President Biden has banned the sale of antivirus software made by Russia's Kaspersky lab. Commerce Secretary Gina Raimondo said that Russia's influence over the company poses a significant security risk, noting that Kapersky's customers include critical infrastructure providers and also state and local governments. Retail sales in the United Kingdom increased 2.9% in May of 2024 over the previous month's revised 1.8% drop. Sales volume rose across most sectors, with clothing retailers and furniture stores rebounding following the poor weather that we saw in April. Also, sales volumes rose by 1% in the 3 months to May 2024 when compared with the previous 3 months. However, they fell by 0.2% when compared with the 3 months to May 2023. Yesterday, we brought a report on the Bank of England holding interest rates in the last meeting before the elections early next month. The meeting held yesterday. Here's a replay of our analysis. In the UK, services inflation fell to 5.7% in May from 5.9% in April of 2024, above forecasts of 5.5%. The annual inflation rate in the UK, however, slowed to 2% in May, the lowest since July 2021, from 2.3% in April, and in line with forecasts, having now returned to the Bank of England's 2% target, led by a slowdown in costs of food and gas. In March, Bailey sounded optimistic, saying that we don't have to actually get inflation all the way back to target to cut rates. For instance, we have to be convinced that it's going there. Also, we saw the committee, that's the Bank of England committee, that was today, say that the timing of the upcoming general election in just 2 weeks' time was not relevant to their decision, which they made to hold interest rates at 5.25%, insisting that the decision was made on the basis of what was judged necessary to achieve the 2% inflation target. Two members preferred to reduce the bank rate by 0.25 percentage points like the previous meeting to 5%. At its meeting ending on 19th June 2024, the MPC voted by a majority of 7-2 to maintain the bank rate at 5.25%. The BOE said they see inflation still rising, albeit slightly in the second half of this year, as declines in energy prices last year fall out of the annual comparison. Services consumer price inflation was 5.7% in May, down from 6.0% in March, but still higher than what they expect to see. They also saw that the restrictive stance of monetary policy is indeed weighing on activity in the real economy, leading to a looser labor market and bearing down on inflationary pressures. At the next August meeting, the BOE say they are prepared to adjust monetary policy as warranted by economic data to return inflation to the 2% target sustainably. The bank will therefore continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including labor market conditions, wage growth, and services price inflation. Having watched the conduct of monetary policy committees in various countries for over 10 years, three things that I see as most pertinent as I've been following these central bank decisions. One, of course, is independence. First, of course, independence from the politics and executive is, of course, required, but also from markets and their own expectations driven by an array of considerations. Independence can come at an increasing political cost as a wave of anti-incumbency driven by unbearable financial conditions hits voters. But the last thing you also want to see is MPCs that are driven by market views. Second, the uncertainty around data integrity. We have a multiplicity of factors which make data more difficult to predict and interpret for central banks. Data dependence can box the MPC or the FOMC or the committee into a hole, depending on the integrity and factors shaping the data you are working with. The danger here is that policy actors will kill the economy by acting too late to reduce rates. The most important issue, I think, is varying factors that impact inflation differently. In some environments, it is mainly the supply factors like oil demand shock or insecurity in, say, Nigeria. In others, like in the US, it tends to be more demand, and sometimes it's a bit of both. Supply side reform can be more complex and difficult to execute, and interest rate changes have become the easy magic bullets simply because they are easier to execute. In many countries where borrowing appetite or intensity of borrowing is low, with most of the population unable to afford to borrow and most people working in the informal sector, effectiveness of interest rates as a tool to manage inflation and get maximum employment is really questionable. In richer economies where wage growth tends to be high, the journey to bring prices down can also be longer as high inflation expectations keep prices up. The next Bank of England decision will be in August, when a new government, most likely a new party, will be in power. The Bank of England have taken a cautious decision today and explained it with sticky services inflation, saying that the drop to their 2% target does not look sustainable for now, even though it was achieved in the last data. Some analysts see a clear signal to the markets and the public that after the bank completes its new forecast for the economy, a cut is now the most likely outcome at its next rates meeting in August. But no one really knows for sure. For now, mortgages and costs to borrowers in the UK will have to remain at an all-time high. And this is more bad news, of course, for Rishi Sunak. Prime Minister Justin Trudeau's government is reported to be preparing potential new tariffs on Chinese-made electric vehicles as the value of Chinese electric vehicles imported by Canada surged more than tenfold to $1.6 billion last year. Yesterday, Ontario Premier Doug Ford accused China of taking advantage of low labour standards and dirty energy to dump electric vehicles in the Canadian market. And still on Chinese vehicles, Italy's antitrust authority has fined a local car maker $6.4 million for illegally labeling vehicles from Chinese manufacturers, including Chery Automobile Company, as Italian-made. DR Automobiles has been promoting cars, including fully electric vehicles from Chery, BAIC Motorcore, and Anhui Jiangua Automobile Group, or JAC Motors, as Italian-made since at least December 2021, with very minor finishing in Italy. DR Automobiles has said it will appeal the fine. Nigeria increases its domestic gas availability with announcement of a $550 million investment in the Ubeta gas field development project. The final investment decision, FID, was signed by the Nigerian National Petroleum Company Limited and Total Energy, the operator of the OML 58 license where the Ubeta field resides. The project involves a commitment of $550 million to extract 900 billion cubic feet of non-associated natural gas from OML 58, situated approximately 85 kilometers from Port Harcourt in the Niger Delta region. The gas, targeted mainly for Nigeria's domestic market, also augments the operational capacity of Nigeria LNG Train 7. Still, in Nigeria, the total debt stock rose by 24.33 trillion naira in the first quarter of 2023 to 121.67 trillion naira from 97.34 trillion naira as of December 2023, according to data from the Debt Management Office. According to a statement yesterday, total domestic debt rose to 65.65 trillion, that's about $46.29 billion, while total external debt was 56.02 trillion naira, that's $42.12 billion. Earlier in the year, the International Monetary Fund had projected that Nigeria's government's debt as a percentage of gross domestic product for the year 2024 is expected to rise to 46.6% in 2024 from 46.3% in 2023. Oil prices consolidated after hitting 7-week highs in the week. In early trading, Brent futures slipped 0.1%, still over $85 a barrel. Crude oil prices had resumed its rise on renewed hopes of a summertime upswing in fuel demand, also eroding inventory levels. The Energy Information Administration yesterday reported an unexpected decline in U.S. crude oil stocks change for the week ended June 14. Asian markets somewhat mixed as markets digest the latest Japanese May inflation print. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Thank you very much for watching. Bye-bye.